So I had a friend recently who had several different loans they wanted to pay off, and they had just a little bit of extra money each month, and they wanted to know what the best way to pay down that loan quickly was. So first of all, if you have even one loan, anytime you pay extra each month, so if you have $500 due each month and you pay an extra $50, that $50 is going to go directly to the principal. Also, because you've taken some of the principal down, that's also going to save you accrued interest later. So if you were to put, say, $100 a month on a loan, that's actually going to save you more than $100 each month. Now, if you have more than one loan, assuming the interest rates are constant, which may not be the case if you have, say, credit cards or you have an adjustable mortgage, but if they're all the same interest rate, it's always going to be the most efficient to put any extra money on the highest interest rate. And that's true whether it's a loan for a couple $100 or for several $100,000. It doesn't matter which one has the most amount of money to be paid off, and it doesn't matter how long it takes to pay it off. You always want to put the additional money on the highest interest rate loan. Now, to help with that, I actually made a spreadsheet where you can have up to 10 loans. If you want to get that spreadsheet, you can download it by going to this link here. I'm going to show you how to do that in a second, but basically what you want to do is you want to change the cells that are yellow. And we're also going to make the assumption that any extra money you have always goes to the highest interest loan, and once a loan is paid off, that same amount of money then gets applied to the next highest interest rate loan, and so on until they're all paid off. So for this example, we're going to assume you have 3 loans. We're going to assume that you have a mortgage. We're going to assume that you have some sort of school loan here for $40,000 and 8%. The mortgage was $200,000 and 6% in this example. And let's say you have some credit card debt, maybe $10,000 at 15%, some really high rate. It's going to make the most sense to put any extra money here, and then it's going to make the most sense to put any extra money here, and then it's going to make the most sense to put any extra money there. Now in the spreadsheet, this is just a picture of it, you can change anything in yellow. So you're going to put the amount, the interest rate, and your minimum payment each month in each of your loans. You can put an extra payment here, but my recommendation is just over here, put any extra money there, and you'll see how that affects the time to pay off each loan and overall. So in this example, you can see here is the mortgage at 6%, $1,200 is your minimum monthly payment. And let me take this back to the beginning. So let's assume you don't have any extra money, and let's assume for just a moment that you don't have any other loans. So I'm going to zero out these other 2. So we've all learned at some point, or maybe you're learning now, if you have any additional money, if you can pay anything extra towards the principal at all, it turns out to make a huge difference. So when you look, $200,000, 6%, minimum payment $1,200, that's a 30-year mortgage. But let's just say you had an extra $100 to pay extra month, which is a modest amount. Now, you would normally have to pay $231,000 in interest, and it would take you 30 years to pay off. Putting $100 extra a month would actually shorten that by just over 5 years and a whole lot of money. So you can see that makes a big difference. So if you had a single loan, it's powerful. Let's look at what happens if you have multiple loans. So I'm going to put the other values back in the cells so that you have the other loans as well to pay off. So now I put the other 2 loans in there. So we have a student loan for $40,000 at 8% with a minimum payment of $490. And then we have a credit card at 15%, $162. You can see that this is going to shorten this to 20 years. And the reason is you're going to pay off the credit card and the school loan before that, and any additional money that you were paying to those loans is now going to go to the mortgage, and that's going to shorten that. Maybe you have $100 extra a month that you want to throw on, and you're going to see that that is going to go initially to the credit card and shorten that because that's the highest interest rate. Now, if you want to use this for real, you can go ahead and anytime you actually make a payment, put that in here, and it will recalculate everything below that. Also, I want to show you the graph here. This is actually a graph of the payment. So the blue one is the overall debt that you have. This pink one, starting at 200K, is the mortgage, and you can see it goes down each month as you pay. But at some point, you're going to pay off the credit card debt, and any additional money is then going to the next highest interest rate, which is the student loan in this case. And then once that's paid off, that's going to go to the mortgage, and you can see it going down much quicker. But even though the credit card is a small amount of loan, it's always going to be better to put the additional money on the highest interest rate. And then once that's paid off, put on the next highest interest rate, etc. Caveat would be careful when you do this if, say, you had a credit card that might balloon to some obnoxiously high interest rate, or maybe you have a mortgage that's an adjustable rate, then you've got to think carefully. But all things being equal, it's always going to be better to put the extra money on the highest interest rate loan until it's paid off. This spreadsheet allows you to do that. You'll put in the loan values, up to 10 loans across. You've got to put the starting balance, whatever that is currently, the interest rate, assuming it's fixed, the minimum monthly payment, and then if you have any extra money, put it here. And you can follow each individual loan if you scroll through, or you can look at what it's going to be overall. This date doesn't mean anything other than the first payment in this table. So you might put today's date, it could be payment from 10 years ago, it doesn't really matter. So I made this a few years ago, and somebody was asking me about it today. It occurred to me that it might be useful to somebody, so I hope you find this useful. If you have any questions, let me know. I did just want to take a second and show you that in this scenario with the $200,000 mortgage, the $40,000 student loan, and the $10,000 in credit card debt, if you don't put any extra a month, it's 20 years. It's not 30 because the money that would have gone to the other loans went to the mortgage. But if you put even just $20 a month, that's going to save you 4 months and $7,000 over the course of the loans. If you put $50 extra a month, that's going to save you $15,000 and shorten it by over a year. $100 saves you $27,000. $200 a month saves you $44,000. And $500 a month extra, which granted is a fair amount of money to shell out, is going to save you $78,000 and shorten the payment term by 7 months, get you down to 13 months. So interest is a powerful thing. Hope this helps somebody out there.